Greetings, market rebels. Welcome to this week's combination macro measure sector situation video. We normally do these on Sundays, so we're sticking with that date format, but it is Friday, the 12th. It's about 11 minutes after 4 p.m. The market just closed a little while ago. And I'm getting these taken care of again because I have obligations again this weekend. So going to flash our trusty disclaimer. And I'm also going to then flash our trusty intellectual property rights notice. And that should pop up. There it is. And then I will flash this week's stream of consciousness notes. So this is page 1. And then I'll move on to page 2. And you can see it is a combined video. So hopefully I'll remember to cover all this stuff, but I'm going to try to go through it as quickly as I can. I would definitely go back to this slide here and note the first thing is set your playback speed to 2x, right? That's what you want to do. I'm sticking with, I still think we're going to have strong periods in both directions this year, much like the prior years. The first 2 weeks are any indication, that's exactly what we got so far. The market outlook for me, and big picture wise, like I think there's been a shift towards risk growing, greater concern. But the dollar and the 10-year yield did not really take off despite getting beyond resistance last week, former resistance lines last week. This week and last week combined, some sectors weakened this week. There were some lower highs that we were concerned about that could develop. They do seem to be, there's the nascent signs of rollovers as a result of those happening. There's negative divergences now happening since we were not able to take out the former highs, I should say, recent highs, and then power through in the major index ETFs. As we noted a few weeks back, it rarely gets better. That does seem to have been a solid take because it really hasn't gotten better since. With respect to the Mag 7, some we talked about that looked good did actually do quite well for the week and kept things buoyed, while others like Apple and Tesla had some really rough sailing, especially Tesla. We did mention that one a few weeks ago that it had a great potential. And then we got the false breakout. We just noted, I think last week, that that's exactly why you have to be disciplined in your trading, because false breakouts can lead to strong reversals the other way. And in this case, it did. We did have some pretty good UOA ideas the first few weeks on some of these Mag 7 names. So I think that's an encouraging sign that we were getting good UOA in these big dogs that we could trade, and they delivered some good movement potential for folks to potentially capitalize on. As I noted already, the dollar and the 10-year yield did not do much, but they did hold above the resistance line, former resistance line, potentially trying to convert it to support. It's been unimpressive though, and we'll cover that on the charts. And then finally, the short-term take is, and I've got some tabs this week to flash on all this. Well, I shouldn't say all, but most of this stuff. The Santa rally fizzled. We've got the poor start to January. These often portend rough years. Right now, everyone that follows that type of stuff is, I think, fixated on the January barometer, which means basically as January goes, so goes the year in the market. So they've got about 2 weeks left. They've got the FOMC that they can play later in the month, that they can play some shenanigans in front of. They've got earnings to play some shenanigans with. So it probably doesn't get too much easier for us, unfortunately, from here. The problem I think that is we've been talking about in the weekend videos and of course during the weekend webinars has been this rate cut timing and the degree of rate cuts. And I think that more folks are now calling that into question with this week's developments. So it's become an even bigger issue. And remember, just like in the spring, they were selling that, people were buying it. They kept the rally stayed intact. We traded it that way. And then once the July EPS season sort of played out and wore out, we noted that there were some things starting to unravel shortly thereafter, and then we got that corrective action for the next really August, SEP and OCT for the most part. So we'll be on guard for that type of thing again. It's not there yet, but there are some concerning signs, which are we have low or similar highs that we've been a little worried about in terms of what that could happen. That was what we were coming into the week thinking could develop. They may have developed, and I do see some negative divergences as well. Again, there hasn't been a trigger in my mind on any of that, and I'll show that, I think. And then what we will do is get into the other stuff. I'll take this stuff off focus, and we'll talk about the charts. And we'll go through this sort of off camera, if you will, but we'll focus on charts and other things as a result. So let me do a quick stop share, and let me just get things repositioned here so we can get through this efficiently. And then that's going to be on that. I want that on that slide, and it is there. And then I want to show my main screen here, which is screen 3 in front of me. And that should give us a chart right now. And then what I'm going to do is really bring up some of these tabs, and I'll work my way down. Oh, I thought that was on, excuse me one second. I thought that was on this page, but I think it is on that page. Why don't I see it? Oh yeah. Okay, so the big picture take on page 2 of this week's Stream of Consciousness notes. I do still think we are in incredible times with all this going on. I do see the potential that folks are talking about, and there's a lot that goes into that. And then I also see the downside potential too. So I'm really conflicted in terms of I'm pretty much neutral and willing to go with wherever the charts take us, which is where I try to be really all the time. But sometimes it's just a lot easier to be bullish or bearish. Right now, I don't think it's that easy, but I do think things slid more towards concern, and I'm probably a little bit more willing to be a bear than I was just a week or two ago. So that's the first thing I would note. And let's just get on to something more like the SPY here instead. I'm flashing like a late in the day UOA Pro idea that we put out. But let's see. So the next part up would be the bull side. And the bull side argument to me is the charts are acting very well. We've been noting that for months at this point. We did say, right, due to inflation, there's catch-up potential, because even if they took prices up 10% through the all-time highs, you'd really just about be back at, in reality, where you were before in terms of the all-time high due to inflation. Remember that this 4th year of the election cycle, and this might be where it's a good time to go to the tabs, if I can find those, and there it is. The 4th year tends to be the best year. This is from, I think, Rebel Pit Pro. The 4th year is your best year. Obviously, we're just 12 days into it. You could see that we started out rough and they recovered. So this was a little bit almost like reversed, right? Where we had early weakness and then a recovery back up, but not really a push higher so far. And then weakness usually comes into mid-month, and that's pretty much where we are now. We come back on Monday right in here. So nothing special, but then they start getting a hold of it as they work maybe towards the FOMC and maybe towards more EPS they can celebrate. And that's your typical 4th year. Here's a look at it during presidential election years on a different view. And you can see it's the light blue that we're talking about. This is the year with the election. And you can see that things kind of are choppy, right, to start the year, get to Feb, and they start to pick things up. So kind of in agreement. They're slightly different, but in agreement. So that sort of sets the stage for the second half of this month, maybe being a good one. And then you get into, well, does the January barometer end up working? And therefore you have a good year after all, because the January barometer's got a fairly good, let's say, track record. Could be, right? Could be the case. The other good parts of the bullish argument, I think, are that the corporate America's running leaner. They've got the AI hype that's created momentum. There's some reports out there that AI is already taking some white collar jobs, and that's saving, of course, a lot of money in terms of expenses. As big picture macro or philosophically, not so sure that's a great thing, but that is what's going to happen probably. And as we've said many times, you're better off buying the hype. And when it turns into tulip bulb-esque insanity, then you're better off selling. But the early parts of height can be very lucrative to buy into. Are you in the early part right now? That's the question of the moment, probably. So that's a lot of the bull side arguments. I don't really see a lot of well-founded bull stuff based upon the economic underpinnings myself. Maybe I'm just looking at it negatively, but I just don't see it. I think the data has become concerning, very concerning, and that's where some of these tabs come in. So let's get right to that. This is really what you've all heard me talk about this. I follow Yale. I think this is Yale Hirsch's son. Yale Hirsch started the Stock Traders Almanac. You got the Santa Claus rally discussed here. You've got the first 5 days of January, all these things. So they didn't pan out, but there is still hope if you end up with a strong January. So that's the possible situation there. But the first part of the so-called trifecta is 0 for 2, as Jeff Hirsch notes right here. With respect to other things, these are sort of in an order, but not entirely in an order. But I've been talking about this just because, to me, the gang has tried to sell this story that inflation ebbs sooner and it becomes part of the rearview mirror and there's nothing to worry about, and the Fed starts bringing rates down. But the talk has started to pick up. Here's Peter Bookvar talking about how you get these disruptions and the transportation costs may trigger an issue, and that could really create problems down the line. So you can start to say, well, how does it all play out? I don't really know to the penny, if you understand what I mean. I can't really translate all this, but this could be a little bit of a bump in the road along with other things. So that's where the talk has been, and it started to pick up a little bit more. Here's goods inflation. They're talking about, here's freight rates pushed forward 5 months, right? So right now, Shanghai to Rotterdam, this has happened here in the dark blue dashed. And then you can see there's a fairly good correlation here. So if that starts to pick up, you're going to see inflation pick up again, and not that, maybe even not by that much, but what that sort of does, if that does happen, right, is really undermines this sooner we drop sooner than later argument, and that argument is still, the markets still seem to think it would appear that that's the case. So let me pull this over here. I'll pull this over for us. Not a big change in sentiment, so I'm not really going to talk about it. Kind of stayed where it was. If you can see that it's very close to last week's. This is what I was getting at, the watch tool, and you're sitting put here. That's largely the expectation, but they still have us going down at least a little bit from where we currently are to just a little bit lower by March. So what I'm thinking is this could get pushed back again. And if it gets pushed back again, then you're going to have the lagging, the fact that lower rates, did not arrive on time. And the effects of lower rates will take a little while to really kick in and show up. Not that they won't help people immediately, but it just will take a little while for that to be borne out, which doesn't really help things. Here's another thing you can check out on Zero Hedge with respect to China and China's economy now being part of this whole loop of why you will not see inflation come down right away. So you could take a look at that if you want. There's another argument that was sort of a friendly argument where Tom McClellan, I believe he's the son of the McClellans, developed the McClellan indicators, and he's got this one out talking about, if you look at this dashed vertical line, he's got that as when the inverted yields start to affect things. It's about 15 months later where it really starts to kick in, and it starts to impact on GDP. And we're not quite there yet, but we're coming up. It looks like we're coming up on that. So that's what I've been saying myself, where I think there's a lag effect on all this, and it'll take a little bit to really show up, and then when it does, it'll be kind of rough. Here's the leading economic indicators in blue, and you can see when you get deep right into where they are into this negative readings, that often precedes these periods that are recessionary. So you can see this is the Great Recession, as they called it. Here's the COVID situation. There's the prior one after the Greenspan influenced 90s tech bubble mania. And so here's where you are. So you can see, right, real GDP is hanging in there supposedly so far. But again, just another thing to be concerned about, especially, right, because yields have really remained, yields have really remained inverted in some cases. So this has been a pretty good indicator of what's about to happen in the future. And I think it's got a very good track record from what I've read and what I remember. And so you've got to have respect for that. Here's just, so you've got massive speculation coming in now. Just wanted to we talked about CTAs being loaded up. We talked about the public being loaded up. Well, you can see they're really loaded up, right? If you put any faith in this graphic right here. This is speculators built the largest long position in NASDAQ ever. So take it for what it's worth, but right, that's telling you there's a lot of people on one side of the boat. Here's other reasons why I'm concerned, and this kind of dovetails with this chart, which I'll cover first. So let's look at the dollar and let's look at TNX. I say think or swim. Let's look at the dollar and let's look at TNX. So here's the dollar, and you'll all be familiar with the channel that we've had drawn to try to illustrate maybe, right, a trend change here after we've been seeing this corrective activity now for several months that coincides with the market rallying. And talked about this on the sort of midday cocktail hour that we had to take care of today because of attendance problems for folks traveling and whatnot. But they're kind of craftily breaking this out of the channel, but still using the former resistance lines as support, and they're holding it above there. So it looks kind of innocuous, I guess you could say right now, but it certainly could slide back into the channel, and then we would say, okay, that's good because the downtrend resumes, right, of the dollar. Usually, right, it's contrary to the market. So dollar going down usually helps stocks go up. We talked about this in cocktail. We talked about this in relation to the metals stock. So just be careful, though, that this is holding above here. If they start to push this for another leg, here's your start. Here would be your corrective phase in here. And then you would be making sure this is working right. Yep. Then you would be maybe starting another leg that would take you up here. And this would be concerning. I think that would start to hurt the market. So be on guard for that. But it's virtually the same thing, really, in TNX. Similar but different, right? It has a very similar look, but slightly different. And those lines should appear. And there they are. And so, again, it's a very similar thing. And they pulled this back a little bit. And it looks like it's failing. And it very well may be. But they're keeping it above that, out of the channel for now. And if it does start to reverse higher from here, then you've got you've got a higher low potentially put in, and you'd be outside of the channel, and there'd be again that look of maybe there's another leg of this to go. Again, something that I don't think would be very good for stocks. I mean, the inverse relationship's been pretty strong here between the higher yields or lower yields and the stock prices and the performance of the major index ETFs. So with that in mind, we will get back to the tabs. And then we'll do our charting after this. There you go. So this would add fuel to the fire, right? If they do start to engineer or a legitimate dollar rally or both start to happen, then you've got this super short position that's been established in the US dollar. It's the largest since 2020, and it's one of the largest in history. So just keep that in mind. The market is really net short according to this data from Morgan Stanley macro bond. So just keep an eye on that. Something that should keep you concerned that it might not just be a rally, it might be a squeeze that turns into something a lot more concerning because it has a lot more momentum behind it. This is another concerning thing. This just kind of gets to that point where I've been saying I feel like there's something lurking out there. This really isn't what I meant specifically. I just have a sense that there's something lurking from all the, I guess it's probably from all the reading that we do and the link sharing that we do, Ryan, myself, Greg. But this is got to be on your radar, right? That the unrealized losses now account for 33% of all bank equity capital in the US. So not a small thing at this point. So it's just something that you don't know what could trigger a crisis, but it seems like it's getting worse, right? So it's getting worse. Things like this, right? Office buildings being down 40% from their peak over 2 years ago. I saw reports in Calgary, Los Angeles. I'm sure there's other ones that I haven't seen of buildings just really major office buildings really taking a beating on price over just the past few years. So it's not only that in terms of where they're being priced, but most of these office buildings hold large debt balances. Delinquency rates are rising. Commercial real estate bankruptcies are rising. Okay, so this is I couldn't handle CNBC, so I've been out of the CNBC game now for a while. It just became too intolerable. I'll leave it at that. And so I don't know if they've been covering this kind of stuff. My guess is not. They're not giving it very much airtime. But here's another look at a big part of the economy besides commercial real estate, something that could create a lot of problems in the system, so to speak, is this situation in housing. So they haven't had buying conditions that are as this bad since 1960. These are the worst buying conditions that are on record as of right now. So you haven't had the spike to 2-decade highs in mortgage rates. They're claiming here at Game of Trades, this is a leading indicator of the business cycle. So buying conditions for housing is surveyed by consumers. Totally different story than how XHB's behaving, XLRE are behaving, and all the wonderful stuff you hear out of the National Realtors Association and all that kind of stuff. Add to that, right, this Airbnb bust. People have been talking about this for a while. There could be an Airbnb bust because a lot of people probably, as usual, thought it was easy money, had money, thought they were going to make more money, over leveraged themselves. And then, of course, there's a problem because they've got a lot of debt they're carrying and they're just not getting the bookings. So don't know if I can't really say this is that I've researched any of this on a deep level and confirmed it myself. I'm just saying this is what I've come across. Here's a situation where you could see that the personal savings rate has gotten crushed. So this is your current personal savings rate in the US, and then you've got the federal consumer credit outstanding here and US headline inflation. So you can just see that consumers are just borrowing big. It's spiking up along with inflation, sort of a double whammy, and their savings are getting drained. Here's your consumer revolving debt monthly change. This is people are just starting to tap debt, right, in a really big way. They're just starting to tap it in a really big way. It just spiked in a big way. Here's 38% of companies anticipate they'll conduct layoffs in 2024. If you see anything good here, let me know. Here's an economic activity composite. And so you can see that all these various things, order backlogs, employment, new orders overall, see where you are just about now, and look at where you've been, right? You've been either in a recession or nearing a recession when you've been towards these levels. So with all this stuff sort of impacting and still set to impact, this is why I'm growing more and more concerned. That's not the only reason. There's probably twice as many tabs that I've got that I've checked out, maybe even more this week, but that I'm not showing because we could just sit here and talk about tabs, for an hour. I don't want to do that. I would do it if people really wanted it, but I don't think people want all that. Anyway, Druckenmiller recession indicator continues to plummet. Okay, just a reminder on that one. You can see right where we are now is it's got a decent track record of usually if it gets a little bit worse than this, right, you're in a recession. You avoided it here in the mid 90s. That's probably the main exception as to where you were on right there. So just that was touch and go, and good old Uncle Alan, Mr. Magoo, just kept squirting lighter fluid onto the embers as they were about to go out, and they eventually ignited. And then you've got this. Here's your post yield curve inversion rally versus prior cycles. So if you notice this one, here we are in red. That's where we are with the rally that we've seen. It's similar to what we saw in the 2006-7 rally. And then all prior rallies fully reversed going into downturns or downtrends, right? So this has been quite impressive, like we said. Don't know, right, if I can't vouch for this, it's supposedly from Bloomberg, but it just gives you an idea that this is sort of really bucking history in a couple of different ways. And so you almost have to wonder, well, these inverted yields situations are as reliable, like what's going on here. But again, the market can do what the market can do. This is kind of interesting, right? Because here's your ISM composite index in red, and you're really about to drop below the 50 level here. So you can see that when you start really dipping below there, it's not often very good as to what happens. There's only a few instances of it, and it's not very good. So just keep that in mind. There's a bunch of stuff out there. I could keep, going and going and going. But you can see that, this is the claim right now. I'm dubious of this claim that we've really had what they claim we've had, but it is what it is. We just showed similar things here, but you can see this is CEO confidence survey versus employment, with CEOs being blue and employment being red. And you can see that it does track to a certain degree. This obviously the employment quarter net change is not as volatile typically as the CEO confidence survey, but there's definitely some sort of a tracking or correlation there. And right now, this is on the verge. It was on the verge a few months ago of taking out the low, and it's on the verge of if you do take out those lows, then the spread will be even larger. So, and eventually, you can see the employment situation gets, it tends to get pulled down with the confidence survey being results. So, just something to be on the lookout for. Let's get back to our charts now. And we did talk about this, so I'm going to skip over that. I'm going to bring this up here. And what I'll do is we'll probably talk about this and then make sure all of our comments are covered, and we'll wrap it up. But I think the first thing I'd like to show this week is the SPY starting to show some divergences. And it might be better if I switch over to my trading view on this. And I might do that. I just might do that. Let's see if I can do that right here. So let me go back to SPY. I think I had some, and it's, yeah, for some reason, I don't like what it's showing me there. Let's go back here, SPY. Maybe it'll show up here. I'd rather have something more simple. Not exactly what I wanted, but we'll use this because I think it's a little bit more simple, but to check out. Come on. Just to widen those out a little bit. But I think what you can see, I'll just drop a flat line on here where we closed, just about there. It doesn't have to be perfect. You can see those are very similar highs. The one we saw late in the year, the one we just made the last two sessions, did not close very impressively. The trend looks excellent. Obviously, the SMAs look excellent. But under the surface, you've got this. You've got this sort of loss of momentum for now. And sometimes these things just resolve themselves right in the same way you would expect in the direction of the trend. But this is not looking very good right now. Oh, it doesn't like what I'm doing there. Okay. It doesn't look very good. I shared a picture, I think, in an idea, or maybe even in Rebel Hit Elite chat this week. I mean today, excuse me. But yeah, you could clearly see what's going on there. So that's a loss of momentum. Things are not really powering the way they were, and so I think you've got to be on guard right now, because it really won't take much to. There's the kind of that M double top look, and it won't take much, right, to bring some of this stuff down in a big way. And it's kind of jumping ahead, but if we come over to some of these sectors, you could see that the consumer discretionary may have put in a lower high. And that's what we were saying, that if they rally and start to roll over this week, they may be putting in lower highs. We don't know yet. In the case of XTN, the transports, an important sector in my mind, they did. And they then took out the lows and they're on their way. So not much of a, at this point, right, hasn't been much of a really strong rally attempt, you'd have to say there. So there's a couple of important areas that did not really take a turn for the better. Basic materials also did not take a turn for the better. And that's been one of your better sectors over the last, say, 6 months or so. Probably too much, probably like 4 months, excuse me. So that's not good. And some of your big dogs really look a little tired. Like your technology, it did hang in there, but remember, if it doesn't break out and starts to roll over, that will also be something to be concerned about. So it's not, I don't think it's the end of the world yet. But some things just did not do well this week after Roy not doing that well last week. And so the comeback was somewhat narrow in terms of what really did perform. I think honestly, it was limited mainly to technology and communications. There really wasn't this broad buying, and a lot of that may have been some of those big names as well. And Brian McCormick, BMC, pointed this out in Cocktail Hour as well in his video that he recorded. So that's just a quick look at the sectors, and we'll come back to that. But I think you have to be concerned. And another thing is, despite what interest rates have done, the IWM is something we've been saying to keep your eye on, right? Kind of as a telltale sign. And right now, if you look at IWM, we had that. It's kind of interesting, right? Because we had that line from a few weeks back. We thought, oh, it'll probably come back and close the gap if they do sell it off. It'll probably, it's the most likely spot for them to bring it back to. It turned out that it's kind of held fairly well so far. But I did kind of freshen things up and put a new bearish idea in there as of today, because we did see some really significant bearish activity, ostensibly bearish. So what I would say about that is, when we see these bigger players that have been pretty good with it, when they show up, there's sort of conflicting players in there. Some folks, I believe, are just big hedgers that are longs, while other folks, I think, are actually trading this to the short side. Of course, we can't prove that, but they're fairly large trades that go on there. And so someone's using it regularly, and their timing's pretty good. But I would say this, just because a lot of it was put buying doesn't necessarily mean that this is going to fall apart. I think the chance of this thing dropping to the 50 is a real chance, right? A significant chance. That's why the idea is in there. But what I have noticed over the years is that when these guys make their adjustments, they're usually pretty timely. They're usually kind of adjusting just in front of the next big move. So if they wanted to tweak their positions a little bit, the way that they handle things, it could be that they're tweaking right in front of a rally. It could be that they're tweaking right in front of a drop. But what I would say is that we're probably coming up on something relatively soon that'll be a little bit more than the consolidation type action that we've seen over the last week and a half. It'll be more like either this, another leg lower, right, where you actually leave the range, or it'll be, look, this thing's held and they're working it back up and they're going to try to go for the highs again. As it stands right now, I would tend to think it's more down, myself, because this is not a good looking candle in my opinion. I think the on balance things took a little bit of a turn for the worse. I think if it would have taken out this low, I do think the next logical place to come would be this retracement area, the breakout area not too far from there, which is about 187.50 ish. And then, of course, the 50-day. So that was really what I had in mind. And if it gets worse, it would be certainly more than that. You could start looking at other SMAs and other retracement levels. And I try to look just from experience, like, will the confluence matter here at 50%? All these SMAs bunching up probably would, right? So that would be like if you don't hold at the 50, you got to think they try to put up some kind of a fight here. But this was mainly based on the gap, right? And the fact that when this did crack, that it would start to come somewhere beneath the 23.6, and somewhere it made a lot of sense to come here. We thought there was a little bit of flatline-ish type support there nearby anyway from this other action back here. So that did happen, and now you're in a situation where the RSIs are kind of back to neutral on the larger charts, bigger picture charts, and they're a little bit more towards neutral to slightly over towards oversold, but not right on some of the other intraday type views. But yeah, I think right now odds are that this thing probably comes back. And I'm trying to extrapolate that and say probably that means that they try to push rates back up. The dollar probably goes up a little bit. That's what I would think. But right, we're just going to trade whatever comes our way. So we're prepared for that. I'm kind of favoring that, but I'm willing to change my mind in the first 5 minutes on Tuesday after we get through the holiday weekend. It depends on what news has transpired, what bond markets are doing, so on and so forth. But I do think overall, you can't really be too happy from looking at this kind of on a weekly basis. The weekly kind of got me worried with today's ugly action. I think by the end of that week, the end of the week we were in, you kind of registered your worst close for the week, really. So not a great performance. There could be more to come as a result. Diamonds, we may as well look at those while we're here. The diamonds, right? They've kind of not budged. I'm not going to go into drawing the divergence because it's just so obvious, right? So not that you can't lose momentum if you go sideways, which you have, but this is not looking good here, right? A little bit of a crack. If you crack the 20, you're basically cracking a support line. And so that would open the door towards more retracement, possibly it too visiting the 50. So usually I think of late they've been rallying into the Fed. So if you stop and think about it, the smart time to get the ugliness out of the way, if your plan is to rally into the Fed at the end of the month, would be to have the ugliness happen before regular expiration, get it out of your system, and then after you come back from that, try to start improving things and then working your way into the Fed. I don't know if the Fed's going to give you the magic tonic, but again, I don't really know what dirt they've got on Powell. It does seem that they've got dirt on Powell, like they've got dirt on everyone. And he went ahead and, suddenly changed the tune he was singing. I don't know what they threatened him with, but whatever. That's what the administration does when, really, I guess, especially when you're approaching elections. But right now, you've got this, again, potential for what I would call a double top, and a little bit of weakness is concerning. Now, if you see yields start to just keep plunging back into the channel, dollar goes back into retreat, all right, I'd still be willing to trade the upside at that point. But I think you have to, given where everything is and some of the deterioration we've seen, some of the distribution we've seen, the fact that so many people are long this market, and the usual suspects that tend to be late to the party seem to have loaded up late yet again, and in a big way, maybe a historic way. And a lot of those gains, I think, initial gains were fueled by poorly positioned players in late OC. Yeah, I think there's definitely room for more retracement here. We'll see, but that's where I'm coming from as of right now. cues, what can you say? You all can see this, even though we're not on Trading View, which I think shows it better. But you can just see that the momentum just hasn't come back yet. Every attempt to keep going has just resulted in momentum waning, not as good as it was. These compound divergences are tricky because if a market hangs in there and a lot of people start trading the negative divergence and anticipating and not in fact getting confirmation, that can help squeeze things to a higher level. So as always, it's going to always be tricky, but I think you start to fall below here. You start thinking, okay, this could revisit the lows, maybe revisit the 50s, and then see what happens from there. But the Mag 7, again, big names looked good, but other names did not participate. And they could flip that switch, though. Remember, like if something gets smashed, it does open itself up to a bounce candidate. And they probably would like to bounce Apple in a big way if they can, right? Because of how big of a weight it is. I think Microsoft with its performance this week is the top dog market cap wise. I think I heard someone say that, but it would be kind of telling if Apple can't get off of its get off of its off the snide and start to get back above the declining 20 here. You've got the earnings catalyst there a few weeks out. We'll see. You know, they did sell off in front of the last one and then rallied into. Maybe that's what you need to see happen. But if you were just charting this right now, let me just get a little more data in for us. The concern would have to be, you always have to think about false breakdowns or breakouts everywhere, by the way, just as another overly concerning reminder by me, but I can't neglect to do that for people that are new. But if you fall below the purple 200, basically you're taking out that low at this point. That's when you start to really, I think, become worrisome about what could happen there. And again, they do a great job of barely exceeding key levels like that and then reversing them hard. So you just never know until you play it out and manage it properly. But right now, you know, that does have in my mind, this kind of a strong leg lower, this reflexive bounce off the 200. And if you start rolling over again, sure, they could hold it there, but if they break it down beneath there, then you're thinking, okay, this thing could really start to visit this area. Now, I don't know. There's always talk about is iPhone slowing, this and that, but I don't think you can really like the way that this has performed over the last few weeks. It just hasn't been really working well. TSLA, right? There's another one that we'll take a look at. And you could see this had a really rough one. Earnings are coming up here. It looks like they're going to get it. Now they're on their way to making it oversold in front of earnings, but who knows what the earnings come out. I mean, already at 31, I think on the daily, something like that, right now. Yeah, we're at under 32 rounding. So you're getting there, right? You're getting there on the daily. You can see where the support is there near that 211-ish area that just so happens to be a 50% retracement on prior drawing that I made, which goes back a little bit further to, let's see where that goes back to. It looks like it's even further back. Let me see if I can just capture it on the weekly for us quickly. Oh, that wasn't my bad. That was not a retracement. That was a projection. And it actually, so the projection actually worked out to 200. I mean, it's 100 to almost to the nose. So there's just an example of using the fib projections. I haven't even like really registered with that. Didn't even realize that. So now, right, you're looking at this. You could see that the trend went from looking good and breaking out. And we were talking about just a few weeks ago, maybe it has the ability to catch up with the market somehow, but it hasn't. I think the reality of what's been happening with EVs, the kind of the stuff that a lot of the market ignores, or at least some other stocks ignore, they have not been able to ignore that. That seems to have impacted here, and you can see that this 200 is almost like a support line, not perfectly drawn, but you get the idea. and you lose that, right? What are you looking at? You're looking at more and more and more. So there could be even more trouble right on the horizon. So you could have a revisit of this or whatnot. So just be careful there. I think right now that those charts don't look good other than the fact that they are on the 200 week. It could hold there. There could be some support there, but otherwise it just does look vulnerable after kind of putting that false breakout together. So got to be on guard on that one. So that does not look good. Now that we've done this, let's take a look at these as a package deal, because Amazon was one we had an idea in, I think, or was it last week? And that did have a good week. Let's see. Meta had a very good week. Microsoft, I think, had a very good week. We had let's see, I always do it. Somehow I always skip Google, which had paper, and we had I think a good week in there. I hope a lot of good reports come in. NVDA, we had paper, but I don't even know if it triggered once we finally saw the paper show up. Don't know about that. So let's take a look at the Mag 7 as a package deal. And I guess on a weekly basis, it looks pretty good. Probably right, aided by Meta, Microsoft, Google, Amazon, all having solid weeks. And on a daily basis, it actually had the all-time high, if you will, was yesterday there. So, and that's kind of getting up there right towards where you might have some resistance. I could draw a line on that for us right now. We could come across and we could probably get a good line here. May not be perfect, but it'll be in that ballpark. There you go. So there's your idea. There's kind of the upper part of the resistance in the dynamic that the stock's working on. I mean, should say the combination of stocks are working on now. A little stretched on your Bollinger. You can see that distance from the 200 starting to get there. Probably been bigger at other times, but starting to get there. So yeah, kind of another reason for concern. You don't see really the burst through of your indicators in terms of, hey, this momentum's even stronger. Doesn't mean it's dead in the water. It's a fait accompli. This thing's going to roll over, but it's just something lacking that if you're a bull, you'd like to see. It gives you a little bit of pause, right? You get a little bit of pause out of that. So overall, I'd say, look, you can't really complain about the way the whole package is hung in there. You just can't. We took a look at Apple. Let's take a look at Amazon. I said I would cover these, so let's do it. Got to get back to, come on, Thinkorswim. So I've got to rebuild everything since I'm making the move to the trading view charts. And I've gotten a lot of things built, but not all of it. So, a little bit of kind of a negative divergence where you get the higher high and you don't get the strong readings over here in our indicators. So if that's something you focus on, that's a little concerning. With the way the consumer is, that's a little concerning too, given how much credit's being tapped, where savings are, the fact that layoffs are picking up, and people have really probably gotten themselves in credit jeopardy again. But I think there's other things that Amazon is doing that seem to bode well for them in the future. So they might be able to, if you go risk off entirely, no, but if they might be able to weather the storm if some of these other revenue streams start to impact. We did take a look at, let's take a look at Google next. Again, we had an idea last week in Amazon. We had another one in Google this week. Been a dog in terms of a lot of UA, but not really firing. But the last couple of times we had bullish ideas in there, it actually did put decent little pops together. You can see it's very similar, right? Higher high, slightly less impressive indicator readings. So a little concerning. I don't think you're worried yet, right? I mean, if you really want to get worried, get a support line under there. If you want to find a reason to worry, and that would be your first level to start worrying at. All right, so that would probably be you crack and close below. I would say realistically, it's Thursday's low. But remember, with the SMAs right there waiting for it, they should buffer things, right? So that shouldn't really be that bad. And otherwise, I think those charts look very good there, and it's not even overbought on the daily. You wouldn't expect it to be because it really hasn't skedaddled all that much, right, to the upside. Now we'll do Meta. Meta, I know that Ben Ben L was kind enough to mention some stuff about watching the weekend videos and then realizing, that there was an opportunity because we discussed Meta. He took advantage of it. So I'm really thankful, grateful, appreciate the kind words, and glad that it worked out for you. But yeah, I mean, Meta is just juggernaut, much to my chagrin, because I'm really not a fan of not only the platform, but the wannabe 1984 character that's the head of it. Very stretched though. Let's face it. Right now, you're just very stretched there. So I could tweak the Bollinger Bands, but in the interest of saving you the pain and time of doing so, I'll just let it go there. At least the oscillator, right? The RSI is confirming the strength. But I mean, right now you're at 72 on the daily, 75, 74-ish on the weekly. So you're up there and you're beyond your Bollingers. They're not really super wide, but they have widened. I think the stretch from your 200s significant. So again, doesn't mean you get out of it, but how I handle this is if this in the market continue to want to go, I'm just more of a roller. Or if I'm not in, I don't go for the 65, 70 deltas. I'm playing the breakout 50 delta, cutting down the capital at risk. And then once that gets to 70 delta, and I've gotten a good pop out of it, maybe 75 delta, I'm going to move into 35, 40 delta because I'm not really early to the party. I'm probably late, much later than much early, if that makes sense. Microsoft, just my little, can't help myself but trying to share tips that have helped me. Microsoft, we were saying it's got to do something soon, right? Kind of like, right, but it finally did. We were noticing, right, that you had some rising SMAs. 50 was rising last week. Wouldn't take much to get it back above all SMAs. That happened really on Monday. So that was good. We knew, right, there was some clearance if it could get through those highs and maybe take a crack at the highs, and that it did. And it did confirm here. But this is a better look in my mind because number one, this is broken out strongly. Your RSI reading is 69, little short-term overbought, at least approaching there, but not outside of your Bollingers, not super stretched from your 200-day compared to Meta. And I would say, look, it's got, I guess there's possible antitrust. I've heard some rumblings about that with Apple, all kinds of things, but there's probably that stuff everywhere. Everybody wants a piece of those pies that these companies have created. But yeah, I mean, that's really it. I can't complain about it other than it's starting to become overbought at this point. What else can you say? I mean, if we look at this and say, well, what's there to like about this? Why would you think it could keep going? I think if you just start looking at maybe it's in this channel right here, might be the best. Don't even need to verbalize why it could keep going, right? Because that's what channels. One thing I think channels help you with, not be all end all, but this is stuff that a lot of people don't take seriously, but I've seen these channels stay intact and work for years at a time. And so you'll never be able to stop me. You'll never stop me from drawing my channels. But you get the idea, right? It corrected, found the 50, bounced off of that strongly, got the earnings there in a nice channel. Basically, strength when the market was sort of timid, turgid this week. I don't know what else you really want from a chart other than it would be nice if it weren't overbought-ish. Not really overbought in an awful way, just overbought-ish. Probably needs nothing would be better than a little pullback for a few days and then to see it have a mild pullback and then re-energize, take the near overboughtness out of it, and then get ready to go and run into earnings and maybe powerhouse its way up. That's just me though. Where are we? We're at we talked about that. Okay, NVDA I think is up next. So this one unfortunately got a little bit of a late, didn't see any UOA from the elite team that does all the hard work to check out all the stuff that comes through the algorithm. And we got some paper, I think it was on, maybe it was on yesterday. I think it may have been on yesterday and so was looking for just a little bit more pop. barely gave us any. Probably not a great trade, but you can only work with the OA when it comes in, right? But overall, clearly, right, a big time breakout. Heck of a week. What do you want to talk about there? You know, the charts have looked amazing for a long time. It's overbought, just much like Microsoft, but clearly, right, those in Meta, in terms of the big dogs, these are your leaders. And this is even, oh, I can't believe it stopped there, if you know what I mean. But there's that. It could, if it again, another one I'd love to see a pullback, start to hold with a mild pullback, see some serious UOA to the upside hit, and boom, I'd be willing to go along for the ride, just because that's a monster issue right now. And clearly one of the market leaders. Bottom line, though, very vertical. You can see that very vertical this week. Hell of a move this week. Single-handedly probably kept this market looking better than it deserves to, along with maybe the other big guys we just talked about. So it is what it is, right? It's short-term overbought. So if you're unsure what to do, use the techniques I described earlier in terms of handling a meta. You can still play the game, just play it a little bit more prudently than usual, not as aggressively in terms of dollars at risk, more aggressive roller, but more selective roller, blah, 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 blah. Tesla, probably really the mutt at this point in this Mag 7. And clearly it is. Got the earnings coming up. If hope springs eternal type stuff. I think that 211, like we talked about, is your level. Who knows what news comes out? But the charts here were on the verge of looking a lot better, and we were waiting for that final sort of piece of the puzzle to click, and it tried and then failed. And this is why you heard me talk about that last week. When you fail, you fail. Just like Mel Brooks said, I think in History of the World, when you die at the palace, you really die at the palace. So that kind of a thing. When you have a big, widely followed, one of the most popular stocks that really fails on a breakout attempt, you have to realize that there's so many eyes and so many small-time true believers that this is what could happen. It's been almost a near relentless, we're going to punish you for not being experienced type of reversal, or not being disciplined, or both. So you lost your trend, and you lost your SMAs, right? And this is what they do. And then the thing is, it's very interesting, is the news always seems to keep supporting them. Probably shouldn't use the word always, but the news supports them. And when they start to really reverse things, it's almost like magic. Let's see what else. Well, I think at this point, it's probably sector time and then wrap up. So let's take a look I'll try to look at the key sectors. I don't think we should go through them all. In the interest of time, I'll get flamed. And I'm tired of getting charred at this point. XLE, you got to cover that one. Big important sector. Frustrated folks yet again this week, right? This is when all of us are tired of looking at this thing and ready to give up on it, that's when the gang will finally do their things. The only good thing I can say at this point is I've been waiting for these charts to flip over, and they were trying, and then it failed. And again, this is what happens when you have a failed breakout. Gets to the 100, gets sent packing, and then boom, right back down towards the lows. This is why you've got to be disciplined when you see that they've reversed a breakout attempt. You just got to either neutralize your risk through smart options trading, or just get out. And then you can always get back in. But you do have a little bit better situation here on the second low. So is this sort of a wide-ish double bottom W type pattern with a little bit better, stuff going on over here? Hopefully it is. That would be good in a way. Wouldn't help inflation, not great for the consumer, but a good sign for the economy and the market overall if that were to happen. But look, it's got a lot of work to do before we can get, just like we were talking about in cocktail hour on the metals. I just think there's a lot of work they've got to do before I can really get a lot more excited about them, just the way I look at it. So it is what it is. XLK, obviously very important technology. This one, you got to be concerned because of the divergence, right? I think it's the potential's there. The potential's there. We know that, but you've got these big earnings coming up. Could they jack? We just saw Microsoft Meta, right? Nvidia. We saw all that. Could they keep tacking on? Is it going to be 98 all over again? I mean, it certainly could be. But look, this is looking right not so wonderful. These protracted these when it starts to get this protracted though, it almost starts to work out a little bit better for bulls in my mind, that they've been able to keep weathering the storm and the loss of momentum hasn't mattered, and then eventually the news cycle flips or something develops and they just are able to finally break it out. Because it's almost like when the divergence becomes compound and so obvious and people really want to get obsessed over it, it's almost like they use that against them. Just saying. I'm not saying it's going to happen this time. I'm just saying. So the good thing about that is the RSI is backed off on the daily. And so if they're going to push it through, I mean, it won't be overbought if they do. They only have to move it up about $1.50. You move it up $1.50, and you're not going to get anywhere near 70. And then, not that that's the magic number for me, but you get the idea. And then you have room to run. And you say, okay, well, where's it run to? Well, you could do all kinds of projections different ways if you want to, or you can just do a very simple, old-timey, fairly reliable way of doing projections by dropping a line on there and then extrapolating how long it would take to get there in a week and a half, and that gets you up to 200. So yeah, I would say there's a chance of a 4% move up in there if the bulls have their way. One thing that's a little concerning, but this flipped around many years ago. Just the buying itself wasn't that wonderful, and so right, I would say last week's selling was more forceful than this week's buying. And if you notice, right, once the heavy buying dries up and things dry up the way they did, that if you're overbought, that does leave you susceptible to selling because the buyers have sort of decided to step back. But they came back a little bit. Let's see, they kind of bucked the trend. Can't really say too much. Very important space. May as well check out SMH while we're right in this vicinity. And that is very similar, right? You can see the divergence is growing, still has room to go there. But look, this is a pretty shallow pullback of the whole number, right? So in terms of if you're looking for where do you pull back to, didn't even pull back to 38 yet. In terms of another leg lower, yeah, you could you can never rule it out. But when you're looking for a nice corrective wave to occur, you really don't want to see the bounce be this strong. You really want to see a kind of weak bounce, maybe like to here, and then lower, and you didn't get that. You got a weak bounce and they did the old magical hold. So what can I say about that one? Overall, I think the charts still look very good there. You do have to be concerned, though, about the lower high potential that we talked about last week. And so that could happen there with some weakness. And then you all know what happens after that. If you start trending back towards the 50 there in gold, and that low, that gets taken out, and you probably have a full leg lower at that point, probably, in most cases. That's that. Let's take a look at communications, another important sector. This thing kind of passed on the week, right? It has been the more docile leader of XLK, XLC, not really as forceful. But look, it did really well. How can you complain about making a new high, right, on Friday? So did really well. Approaching overbought, not really completely overbought. Near the upper end, though, it seems, of the channel that it's working in, and it's almost like it's got a rising triangle or wedge in some people's minds. We would drop this over here. We would drop another one here. You can see what I mean a little bit. Those are going to converge in the future. So that is a little concerning. That's a bearish bias in theory from my recollection and just experience as well. But it hasn't cracked anything, right? Like how are we going to get super bared up here if it hasn't cracked anything yet? I don't like to try to trade the top. I really want to see something that shows me that it's really losing the momentum. but it's hard to really argue against something that's made a new all-time high, and it seems like it has. So that's an important sector. Another important sector is XLF. And this is sort of, I think, lost its mojo. Put a couple bears in this sector this week. Feel like it's really the deterioration's been there under the surface. This is sort of a slow mover. We're not looking at a big dollar drop. It would just be a decent looking visual drop if this were to occur. But I think what you have to really look at here is there hasn't really been any retracement from the high, from low to high. So I think the best thing we could do in this case is to say, let's get a fib dropped on that low right there if it lets me, and let's get it anchored here at 38.01 up at the top. Oops, I just had it and lost it that fast. Getting old, I don't have the steady hand anymore. Let's see, 38.01, and this low here, I believe, will be what? 31.36. We were 2 pennies off. I remember buying like some really when you had a little change left over, you could buy a little kind of like Mary Jane's or something for 2 cents way back when. I don't think you can do that anymore. But anyway, you can see there is not any real serious retracement here. This is due for it. It really is. So I don't know. You can't really like this at this point. The way that I think they front loaded a lot of the great, hey, this is great. These banks are doing wonderfully. Clearly with this rally, which was just utterly remarkable. I don't know. I almost feel like there's a little bit of not sure something else that happened here with this rally. Seems a little relentless for my taste, but right, you basically trade the breakout 38.01, or you start taking out the low on Thursday, and you think that the rest of the market's heavy. You see other problems, cracks developing in the market. You got to think that, again, not a big counter trend fan, but sometimes like it's just there, and I think it's sort of there now, and you got a shot at a decent little downdraft. I don't think anything amazing would happen, but decent little downdraft you can't rule out, I don't think. Oh, overall though, right, something that's really just barely off the all-time high. As of the high today, you were barely off the all-time high. You were 2 cents away. Well, I shouldn't say all-time, but the recent highs at least. Sorry. I don't know if we were higher in the past, but like, it's hard to say like really a lot of bad things about something that was 2 pennies from the highest recent high, or at least the highest high in years, right? So not going to do that. That's that. I guess I got to cover the RE because I talked about it. Sorry for all of the time conscious. But look, this also to me has those signs of been tired. Got to wait for it to get back above all the SMAs. You may as well just use that high there at 39.87 if it regroups. And then I think you could probably trade, despite this being the low. I mean, I think I would just say, look, if this thing breaks down below that close on Thursday at 39.24, I'd be willing to get in there, right? But I would keep it on a short leash, right? But if it does break, there's just not a lot of support right down to the 50. So not a big trade, but it's all relative. The options will reflect that. XHB, again, defying my common sense that maybe not worth all that much in the end. But to me, again, I feel like kind of the coyote is over the cliff. Possible lower high, not a good looking candle today. You could be below all your short-term SMAs with just a hair more weakness and maybe in jeopardy. So just be careful there. Overall, once again, what can you say about something that's hung in there as well as this has in the face of, right, I think logic that would say that's sort of strange to me with all the bad news we're seeing in housing. Healthcare, the defense, one of the defensive sectors, that one is barely off the highs. So a little concerning, I think, right? There could be some positioning here, but in terms of defensive positioning. But look, the thing's done very well. You do have wide Bollingers. You are stretched, right? So this would be a great example if you want to know what does Wayne mean by you're not getting into the early innings. This would be it, right? I mean, this thing's gone up significantly, right? And it's been going up for months. And if you join the party now as a trader, not an investor, but as a trader, you're not really getting in the first or second inning or even the third inning, right, at this point. So, but again, I think the charts, the thing's barely off the high. So you're not going to see anything bad about the charts other than stretched on the Bollinger basis and probably just short-term overbought. It's overbought. It's at 74 rounded on the RSI daily. All right. So there you go. I mean, that's all you got to work with there. I'm not really a big fan of trading against that yet. I want to see some cracking occur, and I don't see any. Staples, they've held their own. They've got a similar RSI reading, not quite taking out the highs. They don't look like they're done yet. They did hold on quite well. Again, a little bit of defensive positioning. The charts overall look really good in there. They're not even overbought. So could there be a rotation where a lot of other things get sold? They go into staples and some other things, and they levitate a few of the big timers, and the market goes to another rotation and sees some profit taking in a lot of stocks, but you don't really see it show up in the indices. As I've said in these videos over the years, that's been the deft touch, right? They've really developed a deft touch for handling all that stuff. I don't know the ins and outs of it, but I do know the technology that's developed for executions, et cetera, probably helps out. XLY, kind of what we were warning could happen. Lower high potentially and starting to roll over. So this kind of did what we thought could happen this week. Not a good sign, right? This is consumer discretionary. This is kind of risk on, risk off stuff here with XLP kind of flashing risk off. This is also flashing a little bit of risk off potentially. This is one of the reasons why I'm taking a little bit more of a lean or tilt towards the bear side. Transports are also part of that mix. And there you have it. And then you can see why. I'm not going to belabor this, but you can see how they are they basically put in a lower high on Monday and rolled over. That's what we're talking about. And hit the 20 served as resistance there in light blue. Now you're below all the shorties and you're on your way down towards the probably right the 78.22 retracement, which puts you right near the 150 SMA there, and that's rust colored. And then you go from there, but that's not a good sign. These have been a good canary in the coal mine, and on the downside. And if they start to really take it on the chin, not good. Basic materials, again, we're doing much better. Nice corrective activity at this point. Definitely getting towards neutral-ish on RSI at this point. Not a good finish to the week. So still has rising long-term SMAs, but you can see the trend was cracked. So it is still really in a corrective mode, I think, until it gets back above those SMAs. So you want to see it work its way above there. Naturally, if it can't hold above this low, then you start looking at the longer-term SMAs if you're trading in there as possible targets, and then combined with being support. XLI, not an impressive week, but got to give it its due in the fact that it didn't really crack, right? So maybe there's lower highs put in here. The 20 SMA, if it's sort of an early warning, got in its way 3 days in a row and it wasn't able to overtake it. So you have to read that, I think, as slightly bearish, right? That one attempt didn't get there, second, third, not able to overtake that 20 SMA. And the shorties are rolling over while the 20 is sort of flatlining. So a little more weakness, there'll be more rollover. And I think, again, you start looking at your fibs, you start looking at your 50 SMA, but that would not be a good sign, clearly. And then finally, XLU, because we always kind of keep an eye on that, take a look at it briefly, but it's not something we trade. Obviously, it's one of the worst places to trade. I've always felt like airlines and utilities are awful, and so are the metals for long periods. CL should just take a gander at oil. We'll take a gander at copper. Again, trying, by virtue of the fact that it's not going down and it's been just withering on the vine, its technical situations improving where the SMAs are getting closer to it. In this case, the 50 in gold. The other shorties are bunched up. With a little bit of effort, it could do something. But again, we've been kind of like our lukewarmness on this has been right. So that's the thing. Like, you want to be bullish, you want to be bearish. But I think overall, when you just keep coming out with lukewarm, I can see this, like, you got to wait till you get more. Otherwise, you could just keep having a bunch of premature entries that are frustrating. You're just like, man, I thought this was going to go, and then it doesn't. Copper, not good. The way that copper behaved here, this is another part of the mix of why I'm tilting more bearish. This is not a good sign. It's now below all SMAs, and you could start to revisit lows if this weakness persists. You're at like 40-ish on the daily RSI, so okay, it's got that going forward. It has supported. If I put the cursor here, we can see that this has been a flat line esque level in the past. So maybe that saves it. But look, this is all deterioration. You can't be excited about that. Let's look at XAU to kind of speak for gold and silver in the interest of time. Gold and silver. Again, this is backed off. The dollar's kind of hung in there. Dollar rose a few weeks ago. These dropped. Dollar sideways. They go sideways for the most part. Right now, clinging to the very remnants of uptrending action with higher highs and higher lows. But you lose this 100 here. If this really reverses, then you're at risk of this whole sort of intermediate term trend being put under pressure with these lows being exceeded on a closing basis. So that could be near the danger zone. It's out of it as of now. Still has the intermediate term uptrend. But again, we'll see. I think, you watch the dollar enters the channel we talked about, then you're willing to do something that way. In terms of looking at the good action here and maybe going long. But if the dollar continues to power and this thing's down, you got to let it go for now. Let it churn its way through. That is the coverage on mostly everything we typically cover. We did skip a few things. I'm just going to make sure we cover this, and then we're going to wrap up. Remember, this is a joint video, so we're kind of there on time in a big way. But we talked about all this already. Inflation not cratering. We talked about the consumer earlier. Again, I think there was a perfect conditions. There's been that led to what we saw from late Oct through the end of the year. There's been all in. That could be a trap. We saw how over leveraged people are in some ways, and also how overly long some players are over the past few weeks. We've noted different things. The key data to me is rolling over. The stuff that's off the main screen that doesn't get discussed. I think the risk of inflation not cratering and rates staying higher is up this week, right? So, and the shipping rates thing could be a part of that in the future. The problem is, like, all the celebration over the rate of change of inflation, maybe albeit bogus, but let's just accept it. It's definitely bogus to an extent. But that doesn't matter because prices themselves, the real prices, are still up dramatically from where they were a few years ago. And there's just no way around that. And it's understated. Like, let's just call it for what it is. This is set to impact more, right? That these rate hikes, the labor market feels this on a lag. That's starting to show up. We saw a little bit of expected layoffs. I do think the easing will happen this year. I just would say, like, it's going to happen a little bit later than in my opinion, than a lot of these people have been building in and hyping. And I also think it's not a good thing a year later. And we've shown that many times, in prior videos. This is the second best year, but I still do believe that bulls have gotten ahead of themselves. I'm still not buying what they're selling, and I still hope to be wrong. I'm not trying to sound like a perma bear. I'm just giving you my God's honest take of how I feel. I feel like I want to be wrong about it, but I still see a lot of forward-looking things that are not cycling back in the right direction. They're still cycling down, and I do think you still have recession risk, and hope to be wrong. So we do want these trends to hold if we're bulls, but you have to be aware of all the things we've talked about. We talked about a lot of that last week. They have been running into the FOMC, and they typically do use EPS season to levitate. Corporate America naturally is only too happy to help the beat machine. And that's also like an artificial construct. And it's, we can get into that some other time. But I do think that there's legitimate performance and then accounting gimmicks. that can help as well. I don't like the underlying story. That's my problem. I still think the underlying story is just not really showing enough signs of positivity. It just isn't to me yet. I hope to be wrong in my concern, but I just didn't like this week's action. This week's action wasn't atrocious, but it just got me more concerned. We did talk about this week again, that there's many standard technicians and some notable e-waivers. Prector was one of them, and then there were other folks mentioned on the podcasts or videos that I watched or listened to that other people noted and said, hey, this guy's on board with you and things like that. And I can't remember where I listened to it or watched it, but there were other big kind of Elliott wave name guys that think that we just went through wave 5 of 5. It's going to be a terminal wave. And again, if a lot of people are banking on that, it just helps the old wall of worry. But I do think they have some excellent points in terms of what they see in the economy and why this could be a problem area. They usually do, though, and sometimes they're right, sometimes they're wrong, but they usually do have good points. Maybe they just overstate how important some of them are. I still think things are lurking out there. We still really can't complain too much about the market. We don't want to see too much in the form of RSI pullbacks below 40. That really wouldn't be indicative. We should take a look at breadth really quickly. That should be right around here. And I'll bring up SPY just to have that in the background of it. But I don't think breadth really took that much of a step backwards this week, right? A little bit of a step backwards, but nothing atrocious yet. The trends right now are have weakened a little bit on everything we've gotten here, just a little bit or not everything, but at least most of them. So again, a little bit of caution, but I don't think it's where it's, hey, beneath the surface, everything's gotten annihilated. And, there's one beam left holding up this whole edifice. I don't think that's the case right now either. So I don't want to overstate that, but there was a slight worsening, I think, in breadth. I have other breadth things I look at, but this is just a quick view on a lot of them, just to kind of tie that together. And again, I still think that you might want to think about, how do I play defense? What do you guys mean by that? I would ask that in a webinar, or ask Bill in one of his webinars that are more educationally oriented. I think premium collection is part of a portfolio strategies. Could matter if the market's a lot like what we saw the first 2 weeks of the year, some down, some up, but not really strong trending action. You could really do well with other strategies, aka iron condors, if you manage them aggressively. So yeah, I think the most likely short-term scenarios, we are not out of the woods. I think you just have, knowing that risks are building, you just still have to just factor that into your position management, your entry management. I don't want to overlook that. That's old. And then the side notes are yep. So they did have excellent market breadth and really excellent stuff in place. But I think that some of these things have started to pull back a little bit, and I still think you could see a little bit more pullback. And again, just thinking about it, it makes sense to me to have more pullback sooner, try to use that Fed and those EPS that start to hit a little bit later to your advantage in terms of marking things back up. The bond market still seems to be taking the rate cut story seriously. I remain unconvinced that we're out of the woods in terms of we're going to come straight down in rates really quickly. But I do think that it's a lot more legitimate than it was really about 10 months ago or whatever. Yeah, we already talked about that. And we talked about mostly all of those as well. So I think that's it. So I think, right, you've got to wait and see how the action develops. But to me, you got to be on guard. I think it just took a little bit of a turn for the worse. If we were kind of, let's say we were 55-45 bullish last week, or 60-40, I would say I would take it down 5%. So I would be more like 55-45 if I were, more bullish. And I'd be more neutral, right? If I were 55-45, it'd kind of be more neutral to slightly negative now, but I'm not really super negative yet. I mean, I want to remember, a big part of what I personally developed for myself that I need to see is I need to see it crack in something. And if you can show me where the SPY is cracked, then maybe you'll change my mind. But, even with my most aggressively drawn, very short term support line, right? This is like on a daily chart. There's just nothing that's cracked, right? How can you say it cracked when it made a new recovery high today, right? It didn't hold it, and that is a little concerning. But I mean, that's where it is, right? So there's no crack yet. So it's really hard to say, oh, I'm 75% a bear at this point. Not even an SMA. You're above the 10-day, the 15, the 20. You're right near the highest high. So I just think you've got to start saying, like, look, the way that some of these things are shaping up, it's gotten a little more concerning. And I'm kind of neutral until I see the whites of their eyes. I either need to start rallying and break out, but I have to probably be on guard for a greater pullback or another leg to a pullback if this market starts to show weakness, because cracking that support line I drew and then cracking the 20, which is right near the 10 and the 15 for that matter, that might lead to a test of last week's low. And you never know, right? You don't know what news produces that or is behind that or is lurking in front of that. And if that happens, right, and you don't hold, then you could see even more selling. So for now, right, we just got to remain, I think, opportunistic, remain nimble. You just can't feel as good as maybe you did about how things were acting when we were back in this mode back in here. So I think on that note, I'm going to wrap up. I want to wish everyone a great long MLK Day assisted weekend. I hope everyone enjoys the time off, and we'll be right back at it, of course, on Tuesday. We will be getting the newsletters out over the weekend, naturally, since we don't have Monday to get them out. We do, but it'll certainly come out before we start. It won't be the first trading day. It'll be prior to the first trading day in this case. So I hope that something I share with you helps you out this upcoming week or some week in the future. I want to thank you for tuning in. I hope you stayed awake through all these minutes of recording. Everyone take care and have a wonderful weekend.